Usually when we think about survival, we picture something, I don't know, incredibly visceral, right? Like straight out of a nature documentary.
Oh, yeah, definitely.
Imagine early humans on the savannah. There's a subtle rustle in the tall grass,
A sn-
snap of a twig, and instantly, without a single conscious thought, adrenaline just floods the system.
right, your heart rate spikes, blood rushes to the muscles, and you just run.
Exactly. It's a binary mechanism, fight or flight. It's clean, it's efficient, and I mean, for hundreds of thousands of years, it's the exact reason our species actually stayed alive.
It really is a magnificent evolutionary mechanism. The whole biology of survival is built on those immediate life-saving reflexes, the ones that prioritize sudden threats over, long-term analysis.
Right. But then you take that exact same magnificent prehistoric brain and you put it in front of a modern brokerage account screen.
Oh boy.
You put it in a 21st century economy where the quote-unquote rustle in the grass is just a red arrow on a stock chart.
Mm.
And suddenly that brilliant survival mechanism becomes the absolute worst enemy you could possibly have.
It is so true.
We're looking at a financial landscape where our natural instincts they don't save us. They completely slaughter us.
Yeah, it is basically the defining evolutionary mismatch of our time. I mean, the very reflexes that kept our ancestors from being eaten by predators are the exact same reflexes that guarantee we will go broke in the modern stock market.
Wow, that's such a stark way to put it.
Well, it's true. We are hardware designed for the Pleistocene era, and we're trying to run software designed for globalized capitalism.
So, welcome everyone. Pull up a chair. We are engaging in a bit of an amateurology session today, that wonderful pursuit where we just, strip away the professional jargon.
Absolutely. Leave the jargon at the door.
Yeah, we ignore all the Wall Street math that is deliberately designed to confuse you. And we just sit down for an intimate, fireside-style conversation about a universally terrifying human experience. Money.
The big scary topic.
Right. Specifically, we're going completely under the hood today to dissect the absolute biggest mistakes beginner investors make. And we're synthesizing this incredible stack of material today to build a real mental model for you.
A completely unified model, yeah.
We're pulling from Nassim Taleb's chaos theory on black swans, Daniel Kahneman's behavioral economics, John Bogle's relentless arithmetic of index funds.
Even going all the way back to ancient Babylonian clay tablets on wealth accumulation.
Exactly. It's a massive deep dive, but we're keeping it casual. Because the paradigm shift we have to make before we even touch a single number is realizing that when beginners fail at investing, the financial industry loves to imply it's a lack of intelligence.
Oh, they thrive on that. They build this whole narrative that, you just didn't read the Financial Times closely enough, or you couldn't grasp their complex algorithms.
Like it's an IQ test or something.
Right. But the truth, which we've pulled from all the greatest financial minds we're synthesizing today, is entirely different. You don't fail because you lack intellect.
So why do we fail?
You fail because your brain is literally hardwired to operate on ancient heuristics, mental shortcuts, basically, that simply do not apply to the slow, compounding reality of the stock market.
Okay, let's unpack this. Because if our brains are the enemy here, we need a very clear map to navigate around our own psychology.
Definitely.
If we look at this chronologically, the first hurdle anyone faces isn't picking a bad stock. The first hurdle is doing absolutely nothing.
Paralysis.
And the core argument here is just mind-blowing in its irony.
Yeah.
The biggest mistake beginners make is this total paralysis, driven entirely by the fear of losing their money.
Yeah, and to understand that paralysis, we have to look far past the moment someone downloads a brokerage app on their phone. We actually have to go back to childhood.
Wait, really? Childhood?
Yeah. The research in behavioral finance points to something called invisible scripts, or like financial factory settings. By age 6, our core money beliefs are largely already formed.
Age 6. That is wild.
I know, but think about it. If you grew up in a household where money was this constant simmering source of stress, where the phrase, we can't afford that, wasn't just a statement of fact, but delivered with this tone of deep anxiety, you internalize that whole environment.
Absorb the stress.
Exactly. You associate money with danger. And this leads to what financial educator Ramit Sethi calls the DNA, the do-nothing approach to investing.
The do-nothing approach. Man, I see this constantly with incredibly smart people. They might even understand the broad concept of compound interest, but they just freeze.
They freeze completely.
They'll leave tens of thousands of dollars sitting in a basic checking account yielding like 0.01%, because they're terrified that if they put it in the market, they might possibly lose a fraction of it.
Right, it's the fear of the red number.
But the devastating irony is that by holding cash in this attempt to be completely safe, they are mathematically guaranteed to lose money.
Guaranteed. The mechanism they are ignoring is the invisible tax of inflation. And it is staggering how poorly understood this mechanism actually is.
It really is.
If we look at the National Financial Capability Study, it paints a deeply troubling picture of our financial literacy. They asked very basic questions about inflation, interest compounding, and risk diversification.
And how did people do?
Terribly. Less than half of young adults, people under 35, even understood the inflation question. Only 43% understood risk diversification. We basically have a population that is financially frozen because they just don't understand the forces eroding their wealth.
I think of holding cash like sitting in a parked car. You feel perfectly safe, right? The doors are locked, the engine is off. You aren't out risking a high-speed collision on the highway.
It feels incredibly secure.
But what you don't realize is that the road beneath your parked car is slowly, relentlessly crumbling into this massive sinkhole. And that sinkhole is inflation. It doesn't look dangerous because nothing is moving, but the ground is literally disappearing beneath you.
That's a great analogy because the loss from inflation doesn't show up as a red negative number on your bank statement. Your balance stays exactly the same.
All right, 10 grand is still 10 grand.
Exactly. If you have $10,000 today, you will see the exact same $10,000 on your screen next year. But your purchasing power is quietly evaporating.
It's just vanishing.
Right. If inflation averages just 3% a year, the mathematical reality is that the value of your cash is cut in half in roughly 24 years. You have lost 50% of your life energy, your stored labor, simply by trying to be safe.
So if you're listening to this right now, you might be thinking, okay, inflation is bad, but isn't the fear of the stock market still justified?
Sure, people always think that.
What if I overcome my childhood invisible scripts? I finally move my hard-earned cash into the market, and the entire global economy crashes tomorrow.
Ah, the big what if. That is the ultimate scenario that keeps beginners completely paralyzed. So let's test it. Let's actually look at the historical data, specifically the most terrifying scenario in modern financial history, the Great Crash of 1929.
Oh man, the absolute worst possible time to invest.
Exactly. J.L. Collins models this out beautifully in his analysis of market history. Suppose you bought into the market at the absolute peak in 1929, right before the bottom completely fell out.
Just the worst luck imaginable?
Right. The market loses nearly 90% of its value over the next few years. It is a total bloodbath. Unemployment skyrockets, banks collapse, people are losing their homes.
The ultimate financial nightmare.
Yes, but let's apply a very specific, practical strategy to this nightmare. Suppose you were just out of school, beginning your career. Assuming you were in the 75% of people who managed to keep their jobs during the Great Depression.
Okay, so you still have an income.
Right. And you utilized a strategy called dollar cost averaging. This just means you ignored the chaos and you kept investing a set amount of money from every single paycheck into the market, month after month, year after year.
Even while it was crashing.
Even while it was dropping 90%. Given that drop, how long do you think it would take to recover your initial losses and break even?
I mean, my gut instinct, and probably what most people assume, is that it would take 30 or 40 years to dig out of a hole that deep.
7 years.
Wait, what? 7 years?
Just 7 years. By 1936, you would have completely recovered.
That is insane. How is that mathematically possible?
The underlying mechanics of dollar cost averaging are what save you here. When the market drops 90%, the money you are investing every month is buying shares at a 90% discount.
Oh, I see.
Yeah, you are accumulating massive amounts of equity for literally pennies on the dollar. So when the market eventually starts to recover, and it doesn't even have to reach the 1929 peak to make you whole, the sheer volume of shares you bought at the bottom acts as a slingshot for your wealth.
The slingshot. Wow. So catastrophic crash during your accumulation phase, when you are young, working, and putting money away, is actually a massive gift. Everything in the global economy goes on sale.
Exactly. But our prehistoric brains feel the pain of a market drop immediately. We don't see the long-term mathematical advantage of buying things on sale. We just see the immediate threat to our resources. So we panic, we stop investing, or even worse, we sell at the absolute bottom.
So if sitting in cash is guaranteed death by inflation, the logical next step is to jump into the market. But the moment you do that, your brain encounters a totally different psychological trap.
Oh yeah, the desire for control.
Exactly. The intense desire to control the outcome. And this leads to our second major hurdle. Once a beginner finally decides to invest, they don't want to just buy a boring, slow-moving index fund. They want to pick winners.
They want the thrill.
Right. They want to find the next Apple, the next Amazon. They completely confuse speculation with investing.
The distinction between those two is critical, and Benjamin Graham, who was the mentor to Warren Buffett, defined it beautifully back in 1934. To paraphrase Graham's rather dense academic language, if you aren't doing deep, fundamental analysis on a business to ensure your initial money is safe and yield a reasonable return over time, you aren't investing.
You're just speculating.
You are just speculating.
Right. An investor looks at the actual machinery of the business. Does this company make a profit? Do they have valuable patents? What are their debts? A speculator doesn't care about any of that.
Not at all.
A speculator just buys a stock because it's going up, hoping that some other person will come along tomorrow and pay even more for it. It's known as the greater fool theory. You're basically just hoping there's a greater fool out there willing to pay a higher price than you did.
Right. It's not investing. It's the thrill of the casino.
But why do we do it?
Well, we gravitate toward that thrill because of a powerful cognitive bias called the illusion of predictability. When we look at history, it seems so incredibly obvious. Of course, Amazon was going to destroy brick-and-mortar retail.
Of course, the iPhone was going to put a supercomputer in everyone's pocket.
Exactly. Because the past makes perfect sense in the rearview mirror, we mistakenly believe we can apply that same clarity to the future. We think we can just intuitively spot the next Amazon. This is exactly where Nassim Taleb's black swan theory totally dismantles our confidence.
I really want to spend some time on the black swan concept because it fundamentally breaks how we think about the world.
It does.
A black swan is an event that has three specific characteristics. It is highly consequential, it is incredibly rare, and it is entirely unpredictable before it happens.
Right. Think of the invention of the internet, or the 2008 financial crisis, or the sudden onset of a global pandemic. Taleb argues that history and the stock market are not driven by the slow, predictable, incremental events we study in economics textbooks.
They're driven by the jumps.
Yes, the massive, discontinuous jumps, the black swans. The market is entirely dominated by these unpredictable events. Yet both beginners and experts suffer from this deep-seated illusion that they can somehow forecast them. We live in an incredibly complex world that we do not truly understand, yet our brains force us to act as if we have it all figured out.
But if you're listening, you might say, well, sure, I'm a beginner. I know I can't predict a black swan. But what if I give my money to a professional mutual fund manager?
Ah, the experts.
Right. These are people with Ivy League MBAs, rows of Bloomberg terminals, supercomputers running complex algorithms. Surely the professionals can analyze the data and pick the winners, right?
Well, the financial industry spends billions of dollars in marketing every single year to convince you that this is true. They sell you the illusion of expert control. But the empirical data tells a shockingly different story.
Tell me about Kahneman's study.
Oh, this is fascinating. Daniel Kahneman, the Nobel laureate who pioneered behavioral economics, studied this intensely. He documented a phenomenon called system noise. Kahneman went into a highly respected, top-tier asset management firm and conducted a blind audit.
Okay.
He took 42 highly experienced, highly paid investment professionals and asked them to estimate the fair value of a single hypothetical stock.
So 42 experts doing exactly what they do every single day for a living.
Right. And here is the key. They all received the exact same one-page description of the business. They looked at identical profit and loss statements, the exact same balance sheets, the same cash flow projections.
They had the exact same information.
Identical hard data. If
Yeah.
valuing a company were a true science, you would expect their valuations to be grouped very tightly together.
Right, like if you give 42 mathematicians the same algebra problem, you get the same answer.
Exactly. But the median variance, the noise, among these 42 experts was 41%.
A 41% difference in what they thought the exact same company was worth, looking at the exact same numbers. That is just wild.
It's unbelievable. It reveals that stock valuation, even among the most elite professionals, involves a massive amount of subjective human judgment. And human judgment is incredibly noisy and flawed.
So they're just guessing.
Pretty much. When we zoom out and look at the aggregate performance of these active managers, the results are dismal. John Bogle, the founder of Vanguard, relentlessly pointed out that over a long-term horizon, say 15 to 20 years, between 75% and 90% of highly paid active fund managers failed to beat their benchmark index.
90%. If you had a doctor who failed 90% of the time, you would run out of the hospital.
You wouldn't even let them take your temperature.
No.
Yeah.
You wouldn't let them put a Band-Aid on you, let alone perform open-heart surgery. Yet, we blindly hand these financial managers our life savings.
We do.
Taleb has a fantastic thought experiment to explain why we still trust them. He says, imagine you put 10,000 investment managers in a room and have them flip coins. Half will get heads, half will get tails.
Okay, classic probability.
Right. The ones who get tails are fired.
Yeah.
You keep doing this year after year. After 5 years, you have roughly 313 managers who flipped heads 5 times in a row.
Just by pure chance.
Exactly. But the financial media hails them as absolute geniuses. They write best-selling books about their quote-unquote strategy. They get their own segments on financial news networks. But it was pure, unadulterated luck. The surviving coin flippers just don't realize they're coin flippers.
Which raises this fascinating psychological question. If the data is so overwhelmingly clear that professionals can't pick stocks, why do beginners still try to do it themselves?
That comes down to a quirk in our psychology called the illusory superiority bias. If you survey the general public, 93% of Americans believe they're an above-average driver.
Which is mathematically impossible.
Completely impossible. But we all inherently believe we have a slightly better memory, that we are slightly kinder, and that we are slightly smarter than the average person. It feels good to believe we are special. So when we look at the stock market, our brain tells us, well, the average investor might fail, and the average mutual fund manager might fail, but I'm not average. I have a gut feeling about this new tech company.
It is profound hubris masquerading as intuition.
Yes. J.L. Collins has a great way of framing this. He compares trying to pick individual stocks to getting into a street fight.
Oh, I love this analogy.
It's so good.
Yeah.
Imagine you find yourself in a chaotic street fight, and you decide you're going to use these fancy, high-flying, spinning martial arts kicks. Now, those kicks look incredible in the movies. You feel like a ninja practicing them in the mirror.
Very cinematic.
Right. But in reality, in the unpredictable chaos of a street fight, launching into a high kick leaves you completely off balance. It exposes your center of mass. You are incredibly vulnerable, and you are highly likely to get knocked out by a simple, unglamorous punch. Picking individual stocks is that high kick. It feels sexy, it looks great on paper, you can brag about it at a dinner party, but it leaves your wealth completely off balance and vulnerable to forces you cannot control.
Taking that street fighting analogy a step further, the data shows that while you are off balance trying to land that high kick, there is someone standing behind you quietly picking your pocket.
Wow.
Because beginners who try to outsmart the market don't just suffer from the bad performance of their stock picks. They get bled dry by the hidden machinery of the financial industry itself.
And this brings us to the third major trap, the silent bleed, the tyranny of costs and leverage. And honestly, this is the part of the amateurology session that just makes my blood boil.
It's infuriating.
It really is.
Yeah.
Because this is where the financial industry actively confiscates your wealth, and they do it in a way that feels totally benign.
Let's bring John Bogle's work back into focus here. He championed what he called the relentless rules of humble arithmetic. It is an elegant, irrefutable mathematical reality. The stock market, as a whole, generates a certain return based on the actual productivity and profit of human business.
Okay.
Let's say that historical return is roughly 8%. Before any costs are deducted, investing is a zero-sum game. The aggregate of all investors in the market captures that total 8%. But after costs, investing becomes a loser's game.
Because Wall Street always takes its cut.
Always. And most people simply do not comprehend how devastating that cut is over the span of a lifetime. The financial industry has engineered its fee structure to be deliberately opaque. They charge you an expense ratio, maybe they tack on an advisory fee, maybe there are hidden trading costs or front-end loads.
Let's define that quickly, actually. A front-end load means they take a percentage of your money the exact second you invest it. Right. So if you invest $10,000 with a 5% front-end load, they immediately take $500 as a commission, and only $9,500 actually goes to work for you.
Exactly. So by combining all these little fees, let's say you are paying 2.5% a year. Now, to the human brain, 2.5% doesn't sound dangerous.
Not at all. You tip your barista 20%, you pay a 7% sales tax on a pair of shoes. 2.5% sounds trivial.
It sounds like a minor administrative fee, a rounding error.
Exactly.
But we have to run that humble arithmetic over an investing lifetime, say 50 years. Let's assume the market returns 8% and you pay 2.5% in fees every single year. Over 50 years, those fees don't just consume 2.5% of your total wealth.
This is where the math gets scary.
It does, because of the loss of compound interest, because the money they took from you in year 1 isn't there to grow in year 2 or year 20. Those fees end up consuming nearly 70% of your potential compounding accumulation.
I want you, the listener, to really absorb this next number because it is the most important math you will ever hear. 70%.
It's hard to even fathom.
If your investments, left completely alone, would have grown to $1 million, you end up with $300,000. The financial industry takes $700,000.
The asymmetry is just breathtaking. The investor puts up 100% of the hard-earned capital. The investor takes 100% of the market risk, and yet the investor only gets 30% of the final return.
It's a scam.
Well, it's legal, but yeah.
Yeah.
The financial system puts up absolutely zero capital, they take zero risk if the market crashes, and they systematically confiscate 70% of the upside. It is the tyranny of compounding costs completely overwhelming the miracle of compounding returns.
I call a 2% fee a financial tapeworm. Think about how a tapeworm operates in biology. If you swallow a tapeworm, it doesn't kill you immediately. You might not even know it's there for years.
Right, it's stealthy.
You just feel a little sluggish, maybe a little tired, but it is silently sitting in your gut, eating a portion of your sustenance, day after day, decade after decade. It slowly starves you while keeping you alive just enough to keep feeding it.
That is exactly what a mutual fund fee is.
Yes, you wake up at 65, ready to retire, and you are financially malnourished. You are poor because Wall Street has been silently eating your lunch for 40 years.
And fees aren't the only way beginners bleed out. The other massive catastrophic killer is leverage, using borrowed money to invest.
Oh, margin trading.
Right. When beginners start feeling confident, perhaps they got lucky and flipped heads a few times in a roaring bull market, they decide they want to accelerate their wealth. So they start trading on margin.
I really want to break down exactly how margin works because it sounds sophisticated, but it's actually a death trap. Margin simply means your broker is lending you money to buy more stock than you can actually afford.
Yeah, that's the basic mechanic.
Let's say you have $10,000. You use margin to borrow another $10,000, so now you have $20,000 invested. If the stock goes up 10%, you make $2,000 instead of $1,000. It feels like magic.
Free money, right.
But if that stock drops 50%, your entire $20,000 investment is now worth $10,000. And remember, you owe the broker $10,000.
And this is where the trap snaps shut. Because the broker doesn't wait around for the stock to recover. They issue a margin call.
Exactly. They don't send you a polite letter asking how you're feeling about the market. If your account value drops too low, the broker forcefully liquidates your assets. They sell your stock at the absolute bottom of the crash to get their loan back.
They protect themselves first.
Always. They take their $10,000 and you are left with zero. A 50% market drop didn't just hurt you, it completely wiped you out. You are permanently ruined, and you can never ride the recovery back up.
It is the ultimate expression of hidden risk. And looking through the source materials, there is an incredible thematic convergence on this exact danger between Nassim Taleb and personal finance expert Dave Ramsey.
Yes, the turkeys.
The turkeys. They both use the metaphor of a turkey to explain the catastrophic danger of hidden risk and false security.
I found this synthesis so fascinating. Let's look at Taleb's turkey first. Taleb asks us to imagine a turkey being raised on a farm. Every single day, for 1,000 days, the butcher comes out and feeds the turkey.
Okay.
The turkey, being a rational creature analyzing its own historical data, plots this on a chart. Every day, the turkey's confidence grows. The statistical certainty that the butcher is a benevolent creature who just loves turkeys approaches 100%. The turkey feels safer on day 1,000 than it did on day 1.
The turkey is looking at a beautiful upward trending chart of daily feedings. It believes it has completely figured out the rules of the game.
But then comes day 1,001. It happens to be the Wednesday before Thanksgiving. A black swan event occurs in the turkey's universe. The butcher walks out, but instead of food, he wrings the turkey's neck.
Boom.
The turkey's entire belief system, built on 1,000 days of solid empirical evidence, is shattered in a single instant. The risk was completely hidden in the structure of the system until it was just too late.
And then we pair that with Dave Ramsey's turkey. Ramsey often talks about the profound myth of using debt to invest, the idea that you should, say, borrow against the equity in your home because your mortgage is at 4% and you can supposedly make 10% in the stock market, capturing the 6% spread.
Right, arbitrage.
Ramsey points out that people who do this are ignoring the catastrophic risk of a market downturn while holding debt. His famous quote is, "Just because you see a turkey flying in a tornado doesn't mean turkeys can actually fly."
That is so perfect. If we synthesize these two concepts, it perfectly describes the beginner investor using leverage. The tornado is a massive, multi-year bull market. Everything goes up. Even terrible businesses, even highly leveraged, incredibly risky portfolios look like they are soaring gracefully.
Everyone feels like a genius.
Right. The beginner confuses the environmental anomaly, the tornado, with their own skill. They think they are a genius bird that has somehow learned to fly. They take on more and more margin, feeling perfectly safe, totally blind to the fact that Thanksgiving is right around the corner.
And when the market corrects, the tornado stops instantly.
The turkey plummets to the ground, and the butcher is waiting right there with a margin call.
This is precisely what Benjamin Graham warned about nearly a century ago. Outright speculation is dangerous, but speculating with borrowed money is financial suicide. We have to fundamentally redefine how we think about risk. Risk is not just about the probability of a negative event happening. It is about the magnitude of the consequences if it does happen. If an event has a 1% chance of happening, but the consequence of that event is total permanent ruin, you simply cannot take that risk. As the old saying goes, never cross a river that is, on average, 4 feet deep.
Because in the middle, there might be a 10-foot drop-off.
Yeah.
And your average depth doesn't matter at all when you're drowning.
Exactly. But avoiding leverage and high fees is only half the battle. Because even if you set up the perfect portfolio, your own mind will actively try to dismantle it.
And that brings us to the fourth major mistake: emotional sabotage. Let's say you actually listen to the mass. You conquer your childhood invisible scripts and get out of cash. You avoid the temptation to speculate and pick individual stocks. You starve the financial tapeworm by choosing a low-cost fund, and you never touch margin.
You do everything perfectly right.
The horrifying truth is, your own brain will still try to destroy your wealth.
We have to step into the domain of behavioral economics here, largely pioneered by Richard Thaler and Daniel Kahneman. They identified a foundational quirk in human psychology known as prospect theory, and specifically a concept called loss aversion.
Loss aversion.
Yes. Through rigorous, decades-long testing, they quantified a strange imbalance in human emotion. Psychological losses hurt us roughly twice as much as equivalent gains make us feel good.
It goes right back to the savannah we talked about at the beginning. From an evolutionary standpoint, it makes perfect sense. If you are a prehistoric hunter-gatherer and you find an extra day's worth of food, you feel good. You are full. But if you lose a day's worth of food, you might literally starve to death.
The penalty for loss was death.
So our brains evolved an alarm system that screams twice as loud for a loss as it does for a gain.
That alarm system kept us alive back then, but in finance, it causes something called myopic loss aversion. This is the incredibly destructive habit of checking your portfolio constantly.
The daily app checking.
Exactly. The stock market is volatile by nature. It fluctuates every single day. If you check your brokerage app every day, you are going to see a lot of red days. Even if the market goes up 60% of the time and goes down 40% of the time over a given year, the profound psychological pain of those 40% down days will completely overwhelm the joy of the 60% up days.
So checking your app daily literally conditions your brain to feel like a loser, even if you are winning mathematically over the long term.
And that cumulative psychological pain eventually becomes unbearable. The alarm bells in your prehistoric brain are ringing so loudly that you are driven to do something, anything, just to make the pain stop.
And what's the only way to make it stop?
The only way to make the pain stop is to sell your investments and go back to the perceived safety of cash. You panic sell at the exact wrong time, turning a temporary market fluctuation into a permanent loss of capital.
And this behavioral psychology merges directly with everyday habit formation. Emma Edwards, who writes brilliantly on the psychology of money, talks about a phenomenon called the fuck it spiral.
Oh, this is so real.
It's a mechanism we see in almost every area of self-improvement, but it's especially destructive with money. Think about the classic diet analogy. You are on a strict diet. You've been eating clean for 3 weeks. You are doing great. Then it's a coworker's birthday, and you cave. You eat one piece of cake.
Just one piece.
Now, a highly rational mathematical brain would say, okay, that was 300 calories. I will simply eat a slightly smaller dinner, and my weekly caloric deficit remains completely intact.
But the human brain doesn't do that.
No. The human brain says, well, the diet is completely ruined. Give me the rest of the cake. I've fucked it now.
Financial sabotage operates on that exact same neural pathway. A beginner sets up a great system, but then they have an unexpected expense, or they succumb to an emotional impulse and buy something they didn't budget for, missing their savings goal for that specific month.
And instead of giving themselves grace,
Right. Instead of just adjusting the following month, they experience the fuck it spiral. That single mistake shatters the new financial identity they were trying to build. So they abandon the entire budget, they log in and cancel their automated index fund contributions, and they go on a massive spending spree.
it's because the belief system they built is incredibly fragile. The moment the evidence, like eating the cake or missing the savings goal, contradicts the new responsible identity, the brain defaults back to the invisible scripts. It says, see, you aren't an investor. You are bad with money.
There is also a mirrored danger to this emotional sabotage. It's not just the pain of loss that derails beginners, it's the dangerous euphoria of early gains.
Oh, this is interesting.
Richard Thaler documented a phenomenon called the house money effect. Imagine a beginner who walks into a casino, puts $100 on the roulette table, and wins. They now have $200. Very often, that person will start making incredibly risky, reckless bets with that $100 profit because their brain classifies it as house money.
Right. They don't feel the psychological weight of ownership over it yet.
Exactly.
They compartmentalize it. They tell themselves, my original $100 is safe in my left pocket. This new $100 is the casino's money, so it doesn't matter if I lose it.
But it does matter. It is a massive mathematical fallacy. Once those chips are sitting in front of you, it is your money. Beginners in the stock market fall into this trap constantly. After a few good years and a strong bull market, their index fund grows significantly. They feel wealthy, and more importantly, they feel bored.
Boredom is dangerous.
Very. So they start peeling money off the top of their safe investments and throwing it at highly speculative, dangerous assets. Unregulated crypto, leveraged options, penny stocks. Because they convince themselves they're just playing with the market's money. They acclimatize to the high risk.
And when the black swan arrives?
The Thanksgiving moment. When it hits, they don't just lose the house money. The contagion of risk usually wipes out their original principle, too.
If you look closely at all of these mistakes, the paralysis of cash, the delusion of stock picking, ignoring the tapeworm of fees, the emotional panic selling, the house money effect, they all stem from the exact same root cause.
Control.
It is the illusion that we need to exert tight, hyperactive physical control over our money to make it grow.
Yeah.
But the ultimate paradox of investing is that the less control you try to exert, the more money you make.
It's so counterintuitive.
Extreme patience and profound laziness beat hyperactive trading every single time. Doing absolutely nothing once you have the correct architecture in place is the ultimate financial superpower.
Which brings us to the pivotal question of this entire synthesis. If our own human nature is the primary enemy of our wealth, how do we protect ourselves from ourselves? How do we build an architecture that survives our own psychology?
We stop trying to predict the future and we start aggressively preparing for it. This brings us to Section 5. The antidote to all of this madness, building an anti-fragile wealth machine.
To build this machine, we have to borrow another concept from Nassim Taleb called via negativa, which translates from Latin as the negative way. It is the principle of addition by subtraction.
Okay, addition by subtraction.
In complex systems like life or finance, it is nearly impossible to predict what will happen next. But it is very easy to look at a system, identify the single thing that makes it fragile, and just remove it.
Right.
You don't try to predict the next 2008 financial crash. You simply remove the margin debt and the expensive fees that make your portfolio fragile enough to be destroyed by a crash. You improve the system by removing the vulnerabilities.
So what does via negativa look like in the real world? What are the actual tools? Let's break them down. Tool number 1 is the index fund. We've mentioned it a few times, but we really need to explain the mechanical elegance of how it actually works.
The broad market index fund, championed by John Bogle, is arguably the greatest wealth-building invention in modern human history. Instead of paying an expert to try and find the needle in the haystack, the one single stock that will miraculously outperform the market, An index fund just buys the entire haystack.
The whole thing.
When you buy a total stock market index fund, you are literally buying a microscopic sliver of every single publicly traded company in the economy.
You own a piece of Apple, Google, the local energy company, the regional bank, the railroad. You literally own a fraction of all of it.
By buying the entire haystack, you systematically remove the fragilities. You completely eliminate individual stock risk. If one specific company goes bankrupt due to bad management, your portfolio barely registers a blip.
Because it's such a tiny piece.
Right. You eliminate sector risk. If the tech sector crashes but healthcare and energy boom, your wealth is balanced. And most importantly, you eliminate manager risk. There is no highly paid human being guessing wrong, churning your account, and extracting a 2% fee.
No taper.
No tapeworm. The only risk that remains is systemic market risk, the overall trajectory of the global economy. But over a long enough timeline, human ingenuity, population growth, and technological advancement drive business forward. With a low-cost index fund, you guarantee yourself your exact fair share of the growth of human enterprise, minus a microscopic administrative fee, often as low as 0.03%.
You completely starve the tapeworm, and you fire the coin-flipping Wall Street expert.
Right.
It is brilliant in its simplicity. But we have to address the elephant in the room. What about the black swans? What happens when a global pandemic hits and the entire haystack catches on fire and the total market drops 40% in a month?
That is precisely where the second architectural tool comes into play, the barbell strategy.
This is such a counterintuitive concept, but it makes so much sense once you grasp it.
The standard advice from the financial industry is to put your money into medium-risk investments. A balanced portfolio of moderate-risk mutual funds, maybe some corporate bonds. Taleb argues that medium risk is a mathematical illusion.
An illusion.
It is highly vulnerable to black swans because the risks are hidden within complex financial instruments. You think you are safe until the system collapses. Instead of the murky middle, Taleb proposes structuring your wealth like a physical barbell. A barbell has heavy weights packed onto two extreme ends with absolutely nothing in the middle.
So extreme safety on one side and extreme risk on the other.
That's precisely. You put 85% to 90% of your wealth into assets that are hyper safe and profoundly boring. This means deep cash reserves, fully funded emergency accounts, paying down your mortgage, and those broad, low-cost index funds that you vow never to touch for 30 years.
Okay.
This 90% is heavily insulated from total ruin. Then you take the remaining 10% of your capital and you put it into highly speculative, maximally risky ventures.
We're talking about things like starting your own business, angel investing in a startup, or buying a volatile tech stock.
Yes. But the crucial architectural rule is that the maximum possible loss is strictly known and capped at 10%. If you put 10% into a speculative venture, the absolute worst case scenario is that the venture goes to zero. You lose the 10%.
Which hurts.
But you cannot be ruined because the 90% is secure. But the upside of that 10%, if your startup succeeds or that single stock explodes, is mathematically infinite. It could return 1,000%. By combining extreme safety with defined extreme risk, your wealth becomes anti-fragile. A negative black swan only grazes you, but a positive black swan can multiply your wealth exponentially.
You guarantee your survival in the worst-case scenario, but you completely expose yourself to the upside of the best-case scenario. And the most beautiful part of this entire system is that none of this relies on new, complex Wall Street algorithms. The core philosophy of this wealth machine brings us all the way back to ancient wisdom. We really have to talk about Babylonian, the camel trader from ancient Babylon.
Oh, yes. George Clayson published The Richest Man in Babylon nearly a century ago, but the parables within it are set thousands of years in the past, translating the wisdom carved into Babylonian clay tablets. The story of Dabasir is particularly relevant to beginners today.
Also,
he was a man who fell into terrible consumer debt, became a slave, and had to painstakingly claw his way back to freedom and eventual wealth. And he did it using a strict mathematical formula.
and the formula hasn't changed a single digit in millennia. Dabasir's rule to achieve wealth was brutally simple. You learn to live on 70% of whatever you earn. You take 20% to aggressively pay down your existing debts, ensuring you aren't flying the turkey in the tornado, right?
Right.
And then the most important step, you take the remaining 10% and you pay yourself first. That 10% is yours to keep, to put into investments that will go out into the world and labor for you like invisible workers.
Pay yourself first. It has been repeated so often it sounds like a hollow cliche today, but it remains the absolute cornerstone of all wealth accumulation. The problem is that human beings are terrible at executing it because it requires constant willpower.
And willpower fades.
But in the modern world, we have a tool that Dabassir didn't have: automation.
Yes. Automation is the 21st century equivalent of carving your financial plan into hardened clay tablets. You do not rely on your own willpower. Willpower is a depreciating asset. Willpower gets fatigued after a long day at work, and that fatigue's what leads straight into the fuck it spiral.
Exactly.
Instead, you remove the human element entirely. You set up your financial architecture so that the moment your paycheck hits your checking account, that 10% or 20% is automatically routed into your low-cost Vanguard or Fidelity index fund. You never physically see the money.
You can't spend what isn't there.
You never feel the psychological pain of parting with it. The diet happens automatically while you are sleeping.
So, if we distill this entire synthesis down to its practical essence, what is the actual physical action someone listening to this needs to take tomorrow morning?
That is the multi-million-dollar question.
It means waking up, logging into your accounts, and having the difficult conversation to fire your expensive financial advisor. It means selling those complex, high-fee, actively managed mutual funds. It means setting up an automatic, recurring transfer into a broad, total market index fund.
And then what?
And then, and this is perhaps the hardest behavioral change of all, it means turning off the financial news. It means deleting the stock ticker app from your phone. You stop checking the market, you completely ignore the noise.
You walk out of the casino, you stop trying to throw high kicks in a street fight, you set up the machine, and then you just let the massive compounding engine of human progress do the heavy lifting for you while you actually go live your life.
Which brings us to a really profound final point about what it actually means to quote-unquote live your life.
Let's transition to our ultimate synthesis here. As we wrap up this massive exploration of all these sources, the resounding, unified message across all these experts, from Taleb's chaos theory to Bogle's arithmetic to Sethi's behavioral psychology, is that building wealth is absolutely not about outsmarting Wall Street. Wall Street is a highly optimized casino designed to separate you from your money.
Yep.
Building wealth is entirely about outsmarting your own human nature.
It's about doing the internal work to recognize your childhood invisible scripts. It's about developing the intellectual humility to admit that you cannot predict the future and having the discipline to refuse to play a loser's game with high fees. You are not a stock-picking genius.
And that's okay?
It is. Realizing that is incredibly freeing because you don't need to be a genius to build generational wealth.
But I want to end on a deeply philosophical note, a reflection that challenges almost everything we've just talked about. We've spent this entire time talking about accumulating money, hoarding it, protecting it from inflation, starving the tapeworm, and dodging behavioral traps. But Bill Perkins, in his provocative book Die with Zero, throws a massive existential wrench into this entire mindset.
It is a vital counterweight to the traditional personal finance narrative. Perkins asks us to look at the intersection of our wealth, our physical health, and our time. He divides traditional retirement into 3 distinct phases: the go-go years, the slow-go years, and the no-go years.
The go-go years being early retirement, your 60s. You have your health, your joints work, you can hike, you can travel the world. The slow-go years are your 70s. You are still active, but you're slowing down, maybe taking cruises instead of backpacking. And the no-go years are your 80s and beyond, where physical decline means you are mostly homebound.
Perkins points out a devastating tragedy in how we operate. So many people become so utterly obsessed with the fear of running out of money, that exact same paralysis we talked about at the very beginning of this conversation, that they violently overcorrect.
They swing too far the other way.
Exactly. They spend their entire lives aggressively hoarding every penny, deferring all joy, terrified of market fluctuations, terrified of spending money on experiences. By the time they reach the no-go years, they have millions of dollars sitting safely in an index fund. But their knees are shot. They can't hike the Alps. They don't have the energy to travel. The pile of money is essentially useless to them because they no longer have the physical vitality to convert that money into meaningful life experiences.
They successfully navigated the stock market, they defeated the Wall Street tapeworm, they avoided the black swans, but they completely lost their own life in the process. They optimized their spreadsheet perfectly, and they end up the richest person in the graveyard.
It is the ultimate invisible script. It is the tragic belief that the number on the screen is the actual goal, rather than realizing that the money is just a tool to buy experiences, freedom, and security while you are alive to actually enjoy them.
I won't leave you with this thought. We started by exploring how your 6-year-old self unconsciously built your current money anxieties. Those invisible scripts that either keep you paralyzed in cash or make you actively sabotage your wealth. But I want you to project forward. What will your 80-year-old self think of the choices you are making today?
Are you sitting in cash, terrified of a black swan crash that might never come, letting inflation slowly eat your life energy? Are you letting a 2% fee tapeworm quietly consume the wealth that could have bought you a decade of early freedom?
Or, conversely, are you so obsessed with accumulating the largest possible pile of gold that you are completely ignoring the present moment? You have to ask yourself, are you building wealth so you can finally start living? Or have you trapped yourself into living just to build wealth?
The balance is everything. The barbell strategy doesn't just apply to an investment portfolio, it applies to life. Secure your future aggressively, but spend on your present intentionally.
Remember that evolutionary brain we talked about at the very beginning, the prehistoric hardware running from the rustle in the tall grass. That brain is perfectly designed to keep you alive. But survival isn't the same thing as living. Your brain wants to panic, it wants to flee, and above all, it wants to endlessly hoard resources out of fear. You have to override it. Set up the automated system. Let the index fund do the surviving for you. You need to focus on the living. Thank you so much for joining us for this Amateurology session. We really hope you leave this conversation feeling empowered, deeply educated, and ready to completely rewrite your financial future. Until next time, keep questioning your invisible scripts and keep zooming out. Take care, everyone.